Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. In the midst of the bank failures last month, the largest U.S. stablecoin issuer Circle broke its peg to the dollar. This over the past year after stablecoin Terra crashed and Tether broke its peg, all raising questions about the risks of stablecoins. Friday, I sat down in an exclusive interview with the head of the Consumer Financial Protection Bureau, Rohit Chopra, who also sits on the Financial Stability Oversight Council, and asked him whether stablecoins should be designated as systemically risky. My interview.
There is provisions in the law that allow the Financial Stability Oversight Council to designate certain payment activities, payment clearing and settlement, as either systemic or likely to become systemic. At a minimum, that could provide a bit more visibility into what is backing these stablecoins, a little bit more insight into how is it going to work across the system? Is there eyes and ears? Because if they do get big, if a stable coin starts riding the rails of a big tech platform or a card network, we could see it rapidly getting adopted. And we need to make sure that there isn't a run on some of these new types of payment systems. It's not just stable coins. We also have to think about P2P apps. Billions of dollars move from people to people and businesses through these apps, Venmo, PayPal. It's common now, but it's not necessarily clear always about whether those funds are insured and what would happen if there was a run. I would hate to see that, and I want to make sure there's safeguards in place so that people can have confidence that their money is always there for them.
So at this point, though, do you see stablecoins rising to the level of systemic risk?
Well, right now, stablecoins have not shown that they're ready for consumer payments. They've largely been used for the purposes of trading in various cryptocurrencies. We haven't seen it get at scale yet like we have with P2P apps, but it could. I think Facebook's Libra proposal from several years ago was a huge wake-up call to regulators around the world that if some sort of virtual currency or stable coin was on a big tech network, it could just rapidly, even overnight, become something that is very big, and that is something we would need to be prepared for.
On the online payment systems, one of your first initiatives here as director was to seek information from online payment platforms for big tech. Amazon, Apple, PayPal, Square, you just alluded to some of this. You're also, I know, looking into Chinese payment platforms, WeChat, Alipay. And I know you've been studying how firms are using this data to target ads, prevent against fraud, and so on and so forth. What have you found so far in your study?
Well, what we have seen is that obviously there's extremely rapid adoption by these types of payment apps and services. So many of us on our mobile devices now tap and pay through services like Apple Pay, Google Pay. We're obviously transacting billions of dollars that way. And I think there are some questions we have about how do some of these services decide to kick a merchant off or kick a user off? How are they actually using all the data that they're collecting through our phones and through what we buy? Are they using that to potentially not just have targeted ads, but maybe move to a world with personalized pricing? So I think there's a lot of big questions there. We also have noticed that, for example, on the Apple devices, only Apple Pay is allowed to use that near-field communication on the device. And we hear from other potential competitors, even financial companies, they want to start their own competing apps, but they can't easily break in because they can't use that tap function always. So these are all the issues that are really top of mind. Of course, We want to make sure that financial privacy is not something that is fake in this country. When you can know every single transaction that someone has spent, that's really a map of their mind and their financial life. And I think people want to make sure that that is safe and secure and only shared when they want it to be.
So then, Director, how does that inform your thinking about potential enforcement action or guardrails perhaps that should be put in place?
Well, I'm not ready to comment on that yet, but I do think you're going to see us in the coming months talk about places that we need to address in terms of risk. That may involve privacy and surveillance, that may involve issues around fraud and fraud detection, but also, fair dealing when it comes to both consumers and businesses.
And given your concerns, you've also said that you have concerns about banks' reliance on these cloud service providers that big tech offers, some of the things you kind of alluded to in your last answer. So does big tech need to be subject to FSOC?
Well, I think the Treasury and the regulators are all looking hard at cloud service providers. You really worry that if something were to happen, could it really take down a lot of core financial infrastructure? And what might be the consequences of that for the economy and society? You almost want to think about, what if there was a major attack by a state or non-state actor? What if there was some sort of outage? There is so much concentrated in a few major cloud providers. So ultimately, there needs to be a look at resilience, but also financial stability. And in as much that the financial regulators need to take action, I think we have to seriously consider that.
How quickly do you see steps being taken on that front? What kind of action, I should ask?
We don't know yet. I think it's hard to know what specific tools we'll use. I think we should be open and understanding what all those risks might be. For what it's worth, it's not just the financial system that might be vulnerable to this. It could be other key sectors, including healthcare, energy, and more. So the growing power of big tech firms, whether it's in payments or cloud, it's something that every regulator I know is a little bit worried about.
Yesterday, the CFPB finalized a rule that's been years in the making. It was mandated by Dodd-Frank. You're directing banks to collect racial and demographic data on small business loan applicants. And you said that can help ferret out and deter discrimination on the lending front, and it can be used in the Community Reinvestment Act, which is looking to offer loans to underserved communities. Already, we're seeing pushback from community bankers. House Financial Services Chair Patrick McHenry says he's going to do everything he can to try to thwart this from moving forward. Your reaction?
Well, this is in the law. The CFPB was under a court order to implement it. And, one of the things I think is so important is during PPP, Paycheck Protection Program, we saw that it was able to save so many businesses, but there was data and reports to suggest that, many small businesses were not able to get credit to save their business. And sometimes that had some disparities. We want to make sure, just like in mortgages, that everything is above board. There's transparency. And we also want to give more tools for investors and policymakers to make sure that any programs they create or investments they make, they have good data around it. So this is in the law. We have to make it work, and we're working closely to make sure we can reduce some of the costs associated with getting it done. We are not requiring it for the smallest community lenders. And importantly, we're including all of those non-bank finance companies that have popped up over the years, both online and in person, and holding them to the same standards. That's just that we have to do that to make sure that there's fairness and competition.
And my big thanks to Rohit Chopra, Director of the Consumer Financial Protection Bureau.